All right, welcome back to the Money Puzzle. I'm Chris Vaughn. I'm here with Eric Douglas today. We're going to do this a little bit differently because all of our other compatriots are out of town on vacation. It is we're filming this going into 4th of July weekend, so they're out enjoying themselves, and Eric and I are here holding down the fort along with Miss Producer back here.
I was just going to call them lazy, but
okay, I was trying to be nice, but yeah, lazy works.
Taking time out of the office, how dare they go on vacation with their families?
That is horrible.
Horrible. Yeah.
What we thought we'd talk about today was because we're recording this on July 1st. As of yesterday, the first half of the year is officially over, and it was epically bad.
Well,
right?
It was interesting.
So, all right. So
a lot of interesting things happening in the first half of the year this year.
I've had in the last several months, as I'm going through performance with my clients, all but a couple of them have said, I know it's bad. I don't want to look, right?
That has been interesting because I've had the same experience with a number of clients. Great clients, and it's almost to their credit where they're like, you know what, I get it. It's not a great year. I just don't really care what performance is. He's like, I trust you.
Right. And yeah, I've heard very similar things, but I think it is important that we do discuss what is actually going on.
Oh, we'll definitely get into it. It was funny. I'll tell you a funny story. I had a client meeting yesterday, and I get to the point where, we normally would talk about performance, and I said, okay, I have the tab up. Do you want to see the number?
Yep.
Do you want to see the number? And they're like, no, we're okay. And I said, it's better than others. It's not as bad as you probably think it is. But yeah, it was just an interesting anecdote where just to see where it's interesting to see where people's heads are at right now. Yeah. Considering this really is one of the worst markets we've had. I mean, definitely in my lifetime. Definitely since 2008 anyway. And there's some market differences between 2008 and 2009 and what we're experiencing right now, which we're obviously about to get into right now.
Yeah. Well, let's go ahead and dive into that. So when we say this was just a horrible opening to a year, and we've heard this thrown around on the news that it was coming, right? Well, now we've got final numbers in. So compared to previous first halves, just how bad was this?
So the fourth worst year ever in the history of the market.
First half of the year.
The first half. This is the worst first half of the year. Or the fourth worst first half of the year.
Yeah, wow.
Say that 5 times fast, right? But in 1940, we had a minus 20.9% drop to start the year. In 1970, this is the worst year since 1970, 52 years ago, by the way. Where 1970 there was a 20.2% drop, and this is in the S&P 500.
Okay.
As of yesterday, the S&P was down a little over 20%. It was 20.6%. Percent down through the first half of the year.
So that's worse than 1970, right?
So that's worse than it's between 1970 and 1940. Yes,
wow.
The worst drop to start a year was in 1932, and you probably know what was
Great
happening
Depression,
then. The
sure.
Great Depression, yeah. And that year started off with a negative 44.5% return in 1932.
Wow.
Now. So that's the bad, right? And what do we always talk to clients about right now, or what do we make sure that we want to make sure that they're doing?
We want to make sure that they're not panicking.
Not panicking.
That's the first thing.
Not panicking, staying the course, making sure everything still fits, making sure their financial plans are still in order, and we're still on path, right? So that's always very important. But I want to back up, okay, what happened in the rest of the year and some of these other years? Because I think this is really good for providing some context to make sure we think about, I'm sitting here telling you how horrible the beginning of the first half of the year was. And we're only talking about the equity markets. We're going to get into the fixed income markets as well, because that's honestly why the year has been so bad. It's not because of the equity market. But so in 1970, we had a 20.2% drop. 52 years ago, once again, we haven't had this bad of a drop in the first half of the year since 1970. The market dropped 20.2%. In the first half of the year. What do you think the market returned in the second half of the year?
I don't know. What do you got?
25.3%.
Up
for the second half of the year.
Right.
So basically at the end of the year, because if it comes down 20, it has to come up 25% to come back to even.
To catch up.
So basically at the end of the 1970, we had a market return of 0%.
Right.
And I mentioned 1932, the market dropped 44% to start the year. In the second half of the year, it returned 53%. So the year-to-date number, when you got to December 31st, was the market was down about 14.8%. certainly nothing to cheer about.
Right.
But it definitely wasn't down 44% at the end of the year. 1962, market was down 26% to start the year, 20% return for the second half of the year.
So in all of those cases, they didn't catch up to where they were at the beginning of the year, but they started approaching it. It was not the end of the world.
You had a good second half of the year. You had a positive price return or positive market basically for the second half of the year. Because what do we always say? Okay, you go down. What do you never want to do when you're at the bottom of a market? You never want to sell out,
right?
Because then you miss the initial run up. In most of these cases, in every one of the years that we've had a worse start to the year than this year, there was a positive price return for the second half of the year. So this year sucks. I don't know. There's not. I mean, I don't know if that's a technical term necessarily, but the first half of this year sucked. I was talking to a client, the same client I just mentioned. I was talking to a client yesterday about this, and there's not really any way to spin the market this year.
No.
It's been a nasty start to the year. We were due. We had record returns in 19, 20, and 21.
Mm-hmm.
Just an unbelievably insane market for the last 3 years.
Yep.
Well, on average, the market's going to get you, for every 3 positive years, you're going to get 1 negative one. Well, we had the 3 biggest, most positive years of the last 3 years. Guess what we're having this year?
Right.
And
I think that's where a lot of people, they kind of forget that.
Yeah.
We've been in a bull market for so long that they have forgotten that this is part of the natural cycle.
It is,
people who have been ready to, jump off the cliff over all this, I just don't understand what's happening to my money. Well, we were due for this. And the longer that we had to wait, the worse it's going to feel, right? And then to your point, the last 3 years prior to this were epically good, right? They were fantastic years. So the higher up you go, when you do fall, it's a further fall and it's more painful.
Yeah.
And I think people forget that sometimes.
Yeah, and I think it's important to remember as well. I mean, what are we talking about most specifically right now? We're talking about the equity markets, the stock markets, and I'm using the S&P price returns because that's typically the most commonly notated index that we use for the stock market. Either that or the Dow Jones Industrial. The Dow Jones Industrial is actually
It's only 30 companies.
Yeah, it's really not even that great of an index to quote, but the S&P is a little bit better and a little bit more common. But we haven't touched on bonds, and the equity market sucks. Don't misunderstand. The real problem this year has been with the bond market.
Yeah. All right. So let me kind of tee that one up for you a little bit. The reason why the bond markets have been the problem this year is, normally when the equity markets go down, you move into more of an income position because that's the safe haven if there is such a thing, right? But we haven't been able to do this year. The bond markets have been arguably worse than the equities markets. All right, why is that?
Well, to be clear, the bond market, this is the worst bond market since we've started tracking the aggregate bond index in the early 70s. It might have been 1970. I don't
Something
remember.
like that, yeah.
It was the early 70s somewhere. I don't remember the exact year, but this is literally the worst year for bonds on record.
Right.
The aggregate bond is down 12% through the first 2 quarters of the year, unheard of.
Right.
And once again, you go to bonds for safety.
Right.
When your equities are going to zig, you want your bonds to zag.
Right.
Or at least to stay flat, and still produce that steady stream of income.
Right. And you think, 12% down on the ag versus 20% down on the S&P. Well, that's not as bad, but the bonds are supposed to be the more stable side of the portfolio, right?
So if your equities are down 20%, well, your bonds are not supposed to be down.
Right.
Maybe down a few percentage points, but you're still getting that regular income. Well, when your bonds are down 10, 15%, and I said the aggregate bonds.
Right.
Corporate bonds are down more than that.
Yep.
International bonds are down more than that. High yield bonds. When we say fixed income, they're just like equities. When you look at the stock market, you have small caps, you have mid caps, you have large caps, you have international, you have emerging markets. You have so many different types of sectors, industrials, utilities, energies, financials, right? There's so many different sectors of the stock market and different types of companies that you can invest in. So it's dangerous when you hear about, the the stock market as a whole, because it's really hard to say the stock market as the NASDAQ, which is much more growth and tech heavy.
Right.
Well, that's down 30% year to date.
Yeah.
28.9 or something like that. That's down even worse than the S&P
Yeah.
500. So if you're a little bit more tech heavy or growth heavy, you're probably down far more than the
Yep.
20%.
That's right.
But going back to the bond market, there is a ton of diversity in the bond market as well. So I'm just quoting you kind of the aggregate bond performance, but a lot of bonds are down even more than that.
They're much worse than that.
So the what's supposed to be zigging in your portfolio is not doing so.
Right.
A number of different reasons for that, but primarily it goes back to Fed policy,
Yep.
the Federal Reserve. And so what they're trying to do to fight inflation is they're trying to raise rates.
It's the only tool that they have.
It's the only tool.
We've talked about that.
It's the only tool that the Federal Reserve has is the interest rates, and the interest rates that we're talking about is basically they set the Fed funds rate or the federal funds rate, which is the rate at which banks borrow money. And we've talked about this before.
Sure.
That banks borrow money from one another overnight. Because banks have to have so much money in reserves, and they have, if they have excess money in reserves, they'll loan it to another, bank because they need they need to make sure that they're maintaining money. But whenever banks have money for themselves that they're borrowing from other banks, let's say if a bank is borrowing money at 2%, they're going to turn around and loan it to you and I on a mortgage or a car loan or something else for 3%.
Right.
That's
where they make their money.
Make their money
That's
on
right.
their spread, right? So when the Fed starts raising interest rates in response to high inflation, because interest rates have been so low for so long,
Yep.
that's been great when you want to get a mortgage, not been great when you're trying to invest in bonds and get a return.
Right.
A regular stream of income on your bond investments. But they've raised rates so fast, so much,
Yep.
so quickly. We've gone from, 0.25%, and now we're already at 2%.
Yeah.
And they've already indicated that they want to raise rates to well over 3.5%,
Yep.
maybe even 4%, depending upon what inflation does in response to the raising of the rates.
Right.
But you have to remember the way the bonds work.
And they're doing it in big chunks, too. They're doing 75 basis points at a time, things like that.
Well, they originally were talking about doing 50 basis points at a
Right.
time, and they've already made one change where they made a 75 basis points increase instead of 50, and they've already indicated in July they're probably going to do another 75
Right.
basis points. 75 basis points is 0.75%.
0.75%, right.
So, but you have to remember the way the bonds work. Bonds have an inverse relationship between value and income or
Right.
yield. So if the price of a bond is X, ideally you're going to have a spread, or the yield that a bond returns is going to be kind of in line. Well, if the price of a bond increases, the amount of income or yield that you receive on a bond decreases.
Right.
In return, when rates go down, the yield goes up.
Right.
Well, interest rates have gone up so fast that prices or values on
Right.
bonds have decreased so significantly so fast.
Yep.
That's what's happened in the bond market this year, when we've had just an absolute record year, not in a good way, with bonds, where they're down in double digits pretty much across the board. So you're looking at balanced portfolios, moderate portfolios. I'm reading a lot of stuff. If you're an industry nerd like we are, you're reading a lot of articles right now about, the 60-40 portfolio is dead. And well, that's probably taking it to an extreme. It's certainly having a bad year. But yeah, it's that is why this market has sucked this year. The equity markets are always going to do, and you always know that you're taking risk in the equity markets. Sure. Your safe haven has not been safe this year, and that's what's made our life difficult. That's what's made it difficult for new retirees or recent retirees that have balanced portfolios. We're talking about conservative portfolios here that are not performing the way that they're supposed to perform. Right. And it's industry-wide. It's everyone you talk to in our business is having these same issues. So.
Yep, agreed. So go back to what we were talking about at the beginning. People are worried, they're panicked. The first thing that I would say, and we've talked about this on the show before, if you're doing your investments with the intention of getting a return, if that's the goal, is I want to get 6% or I want to get whatever number you come up with, when the markets go down, it tends to make you panic a little bit. right? And unfortunately, a lot of financial advisors out there, that's the way they do their business. I'm going to get you a good return, right?
Yeah.
That's the reason we're big advocates of financial planning.
Oh, for sure.
Because the clients that have financial plans are the ones that are saying to us, I know it's bad this year. I don't want to look, right? I know it'll come back. I just need to be patient, right? Because they know that the plan is designed to handle this kind of thing. So go back to what we were talking about at the beginning. You know, those other major cycles where we had huge downturns in the first 6 months of the year. What causes that big upswing in those years past to almost catch back up? And how can we expect that this year if we can?
Well, to understand how we might recover from this, we need to understand better probably what caused this to occur. And this is where, depending upon political affiliation, this is where we might wade into some territories that might upset a few people. But
I don't think it's possible to have this discussion and be honest and not talk politics. We have to.
And unfortunately, the world that we live in, and this is honestly as a result of 2008, the world that we live in, the markets and political policy have become so intertwined over the last several years. It's really, really difficult. I mean, we're sitting here talking about what the markets are doing in response to what the Federal Reserve is doing.
Correct.
The Federal Reserve is a branch of the government.
Right.
Okay? So it's really hard to differentiate between the two sometimes, and especially right now when things are just so intertwined. But what happened in 08-09 to cause 08-09? There was an economic catalyst to it. So we had banks and lenders, mortgage lenders, that were giving out way too much money. We were in a really good time economically. We were recovering from the dot-com bubble in the early 2000s. So we had lenders giving out too much money to people that really couldn't prove their income, couldn't prove their assets. I mean, anybody that was in the mortgage business, no doc loans,
or
I
remember those
low doc loans, things like that. Basically you didn't need bank statements or anything. As long as you had a decent credit score, you can pretty much get anything you want. People that were borrowing 125% of their home's value, just ridiculous loans. So obviously you started having a record number of mortgages begin to default. So you had lenders that were losing money, banks that were losing money. It was a domino effect. So it started with the banks, and it started with home values. Once home values started coming down, realtors, construction, anything in the construction age. I saw a stat recently where about 25% of our economy is depending on real estate, or the homes, basically, residential real estate. Just when you talk about contractors and construction and painters and appliances and everything, right? There's 25% of our economy comes back to residential real estate. And so, you had basically an extreme drop in 25% of the market basically in 08-09. Well, the response in 08-09 was government intervention. If anyone's familiar with what, Bush did back then of the TARP bailout, it was like the most unpopular bailout ever in the history of I think I heard something. It was like the worst pulled political piece of political the worst political bill that was ever been pulled in the history of polling at that point. But you bailed out all these banks that were losing money hand over fist. But what that did was it set up the expectation that when the markets drop, the government is going to intervene.
They'll step in,
What happened in 2020 when the government instituted lockdowns, so we had a government-induced lockdown. So the government's induced these lockdowns, basically tried to shut down the economy, which you never want to shut down an economy. It's for many, many reasons, and as we're living through them right now. But they shut down the economy, government-induced, and then as a response to that, the government printed literally trillions of dollars and gave money out as handouts in the form of child tax credits and also just stimulus money. Well, what happened was people were sitting at home. They weren't going out. Yeah, maybe they were spending more money on Amazon, but they weren't spending money on gas or travel or experiences or all kinds of other things. So we had record savings rates. People were starting to hoard that money. That caused, and when things started to open back up a little bit, we had an economic boom for the end of 2020 and through 2021. Well, chickens come home to roost at some point. The result of all of that government intervention, all of that money printing, inevitably was always going to be inflation.
Yep.
We had record low inflation for about 8 years prior to this year. So kind of going back to record numbers, the record numbers in the stock market and, good versus bad year.
Right.
We were due for some inflation. Problem was we printed so much money so quickly that we had all the inflation. We had all the inflation at once, right? And there wasn't really anything you couldn't avoid it.
Right.
I mean, you had record low interest rates. Well, what happens with record low interest rates, like we had, was, hey, did anybody? How many of you all refinanced your home in the last couple of years?
Right.
I did. I got a 2.75% interest rate on my loan.
Yep.
On my mortgage. That's ridiculous. That is a stupid low amount of money that I'm paying to own my home.
Right.
Money was cheap. When money was so cheap, that also increases the amount of money supply.
Right.
Because people were borrowing more and more money. Most of the time it is attached to an asset, but still you have record numbers of people borrowing money at really low rates.
Right.
So in order to combat inflation, it's amazing how this is
where the Fed policy comes in.
This is all a big circle, right?
Yeah.
It's amazing how it's all correlated. But now the Fed policy is coming in. They're raising rates because they want to fight inflation.
Right.
And they only have one tool in their toolbox. It's the interest rates. They go up, they go down. So interest rates were ultra low. So they had to raise rates to try to reduce the amount of money supply. People, they had to make debt a little bit more expensive so people wouldn't take out as much debt.
Right.
That stunts growth. By definition, that stunts economic growth.
Yeah.
I mean, it literally.
And how do we get out of the inflation problem? Growth. That's how you solve the problem, is with growth.
Yeah. And so we're literally in a position right now, and it sounds so counterintuitive to most people that don't really follow this on a day-to-day basis, but the Fed is in a position where they're almost trying to cause a recession in order to fix inflation.
Right.
Really the only way to fix inflation, honestly, the only way to fix inflation, the money's already out there. The money's been printed. The money is in the supply.
People are not going to give it back.
People aren't going to give it back, right? So it's not like they're going to burn it.
Right.
The money's out there. So because we've printed, the government created the problem. Really, the only way to solve the problem is government intervention. And I don't want to say government intervention. That's the wrong term. Government policy.
Right.
Reducing the amount of money supply, opening things back up for growth. It may be raising rates at a more reasonable level as opposed to what they're doing this year, where they're just taking a fire hose and, instead of turning the faucet on, they're turning on the fire hose, right?
Exactly.
Trying to fix inflation all at once. We heard an analogy yesterday. You and I
we were at a symposium last night.
Yeah, we were at a symposium last night. Shout out to First Trust. They're a great partner of ours. But, they were talking about how the Fed is trying to basically a typical business cycle lasts about, let's say, 7 years.
Right.
You got, growth, hyper growth, right? And then, it comes back down. You think about a bell curve. It goes up and then it comes down. And then, once it comes down, it starts back up again.
Right.
That's kind of a typical business cycle. Well, basically what the Fed's trying to do is shorten the business cycle from 7 years to maybe 3 or 4 years.
Right.
They're basically trying to cram all of this
into a very small
window, basically. So we're almost trying, because we've had such record numbers of growth the last several years, really the last decade, to be perfectly honest, but the last several years specifically. Well, now they're trying to basically hurry up, get through this recession, get it here, get it over with, and move on to the next growth phase. Because ultimately, what they want to do is start lowering rates again. Because then, if you raise rates to cause the recession, to get into a recession, ultimately what that means is you can come in and play the hero, start lowering rates again, and you're going to see the market rebound.
We had there was an economist at that symposium last night. He had one of the best analogies I've ever heard. Eric and I were both laughing about it when he said it. He said that if you look back at history, when the Fed is raising rates rapidly, they keep doing that until they break something, which at that point in time is when we started laughing. And that's when they jump in, they become the heroes by lowering those rates. And that's where that recession word comes in.
Oh, look, government fixed the problem.
Yeah, government created the problem, government fixed the problem. And you and I were talking about this before we started recording today. The most terrifying words in the English language. I'm from the government and I'm here to help. right? I think that was Ronald Reagan was the one who originally quoted that.
I would argue it's somebody do something.
Yeah. That was kind of the point that I was wanting to make is we have a tendency as a society to say, hey, Mr. and Mrs. elected official, do something about this. That's usually the worst possible thing they can do. You ride out cycles like this. You leave them alone. They will naturally work back into an efficient system if you get out of the way.
And it sucks when it happens. It really does. Just having to go through these business cycles of, just negative growth, right? No one likes it. No one likes to live through a recession. But yeah, I mean, we had, everybody wanted the government to do something.
Right.
Well, they did. When COVID hit. Well, they locked everything down. Okay, well, now they locked everything down and people were losing their jobs. Somebody do something. Okay, well, here's
some money. Yeah.
Okay, well, there's your stimulus money. That's going to have unintended consequences on this side where, okay, now we have record inflation. How do we fight record inflation? Somebody do something about this record inflation. Right. Okay, we're going to. It's this vicious cycle that keeps happening.
Horrible
okay,
cycle.
now we have record inflation, and we're going to raise interest rates really, really, really quickly. Yeah. Okay, great. We're gonna and we are, in fairness, starting to see signs of. I don't want to say disinflation, but there are definitely sectors of the economy where we're starting to see maybe a peak in inflation. Mm-hmm. Which is fantastic.
Yeah, absolutely.
But you once again, you take your fire hose and you spray it on everything. You're bound to hit something. But it's also coming along with what's going to be interesting in the next couple of weeks is we're going to find out whether or not we're in a recession right now.
Right. As the numbers start coming out. Yep.
We already. That's two consecutive quarters of negative growth. I tend to think we are probably there. If we're not, we're
headed there in a hurry.
There, yeah. But my guess is we probably are in a recession, and usually the stock market is a fantastic leading indicator of a recession. This is where it's always interesting. Everyone's saying, well, the stock market's going to react if we're in a recession. The stock market's already assuming we're in a recession. If numbers come out in a few weeks and we find out that we're not in a recession, we're going to see a pretty good bounce. Unfortunately, what that's also going to lead the Fed to do is they're going to continue to raise rates because they're going to say the market or the economy is healthy enough to withstand some additional rate increases so we can continue to combat inflation. So it's always be careful what you wish for.
Yeah, exactly. Yeah.
In some ways, you almost want the recession to come. You want the news to be bad so we can continue to bottom out.
Right.
And once we bottom out, we can maybe take a little more healthy, proactive approach to fixing the problem. But
And I would add this to this as we start to wrap this conversation up. We have a tendency, recession is such a dirty word, right? Yeah. We say it like, through our teeth because we hate that word. We did a podcast on this several weeks ago. Recession is what it is. It's not the end of the world. We've had, how many recessions have we had in the last 100 years? It's quite a few of them. People think of the big ones, the 2008, and they think of the 1970s. They think of the 1930s Depression. Recessions happen a lot. Are you pulling up?
I was literally Googling that right now because when you actually look at the number of recessions, it's far higher than most anyone would ever assume.
Yeah. I want to say it's in the 20s or 30s that we've had in the last 100 years. It may be higher than that.
48 recessions dating back to the Articles of Confederation. So
so since the beginning of the country, right?
Yeah, but going back, and this is probably too much for me to absorb right away. But I mean, the fact that I'm scrolling through this list of recessions to figure out what the total number is. Right. I mean, we've had quite a few.
Yeah. And that's kind of my point.
It was like it's about 25 or 26 in the last 100 years.
There we go.
Yeah.
That's kind of the point. Recession, like we said, we say it like it's a dirty word. It is part of the natural business cycle. Yep. We will come through this one, whenever it does happen. It seems to be inevitable. We will come through it. We'll be fine, right? But I think my point, I know you agree with me on this, is the less government is involved, most likely we're going to recover more rapidly, right? Yeah. And more healthily. Is that a word, healthily?
It is now.
I'm going to go with it.
Sure, so, it is now.
So anything else we want to talk about? Just kind of wrap this up because
Well,
this is not the most fun conversation.
So you go back to, the dot-com bubble in early 2000s, 08, 09. I'm just using the two most recent major events just because those, but recessions always seem less important in the rearview mirror.
Right.
Bad news when it's in the rearview mirror. It's like, that sucked, but hey, we're here. We made through it. But we're in the middle of one right now.
When you're looking at it through the windshield, it's a little bit more painful.
When I'll use, this might not be a good analogy, right? But my dad had cancer when I was in college, and he, went through some radiation and chemo, obviously, and it sucked when we were going through it.
Yeah.
But we got through it, and so we look back at it, and this was 20 plus years ago now, and it's in the rear view, and we kind of look back at it. Oh yeah, that was not a fun time.
Right.
But he's healthy today. He's totally fine. We're all good. We got through it. When we look back in 5-10 years, we're going to look back at this moment in history at 2022. We're going to look at it and say, there was a lot of bad.
Yeah.
It was not a fun year. But we got through it. The market's rebounded. It's really hard to think about that happening right now when you're in the middle of the downturn. And we're at the bottom. Maybe we're not at the quote unquote bottom right now.
Right.
We're definitely closer to the bottom than the top, though. And I don't know if this is the ideal buying opportunity where people talk about buying the dip, but you know what? In 6 years, if you bought now and the market goes down another 5-10%, but it recovers, are you going to know? Are you going to remember that you bought it?
I didn't hit that exact date. Yeah.
Yeah, and no one knows. No one knows. Anybody telling you that they're going to predict this? Nobody. We do not know. It's funny. We have these conversations on a daily basis where we're watching the market, and we'll look at each other like, what in the heck is going on? Like,
because it makes no sense what they're doing.
Yesterday is a perfect example. What did the market open yesterday? Down 2.5% or something like that, and then it finished. It was still negative, but it came really close to getting positive.
Yeah,
but
it was almost at break even at one point in time.
But there was no economic news that came out. Really, there was no anything super negative that came out. It was just people were feeling kind of bearish. There's a lot of fear in the market right now, and that makes people do irrational things.
Yep.
And so that's what we're dealing with right now. But I think when you look at historically speaking, and all we can ever do is look at history.
Right.
Historically speaking, when we had horrible starts to the year, the second half of the year historically has always been positive.
Yeah.
It might not always fully recover by the end of the year, but the second half of the year has always been positive.
You'll feel a little bit better by the end of the year than we do now.
So if you look at
history.
If the market's down 20%, maybe it doesn't rebound 20%, but if it rebounds 10%, that's fantastic.
Absolutely.
What we don't want to do is overreact, do something irrational today that's going to cause us to miss out on that potential increase in the rebound in the market for the second half of the year.
Absolutely. All right, so thanks for listening, watching. Eric is much, much better at liking and subscribing and all the rules there. So if you've got questions about the markets, how they impact you, you're worried about what's going on with your portfolio, your financial plan, whatever the case is, give us a call. Reach out to us at 502-200-5210, or you can go to our website at FWPpartners.com. I think Miss Producer's probably going to throw that up on the screen for us if you're watching. But Eric, I'll let you sign us off, and we'll see you next week.
Yep. Thanks for watching on YouTube or wherever you might be viewing our content. Thanks for listening via whatever podcast,
whichever one it is, right?
Channel that you use to listen to podcasts. So definitely leave us a rating and a review if you're able to. Share any of our content with any of your friends or family that you feel might benefit from anything that we have to say. Once again, tune in next time. We look forward to spending some time with you again in the future. Thanks.
The information given herein is taken from sources that IFP Advisors, LLC, doing business as Independent Financial Partners, IFP, IFP Securities, doing business as IFP, and its advisors believed to be reliable, but it is not guaranteed by us as to accuracy or completeness. This is for informational purposes only, and in no event should be construed as an offer to sell or solicitation of an offer to buy any securities or products. Please consult your tax and/or legal advisor before implementing any tax and/or legal related strategies mentioned in this publication, as IFP does not provide tax and/or legal advice. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors. This report may not be reproduced, distributed, or published by any person for any purpose without IFP's express prior written consent. Securities offered through IFP Securities, LLC, doing business as Independent Financial Partners, IFP, member of FINRA and SIPC. Investment advice offered through IFP Advisors, doing business as IFP, a registered investment advisor. IFP and Family Wealth Planning Partners are not affiliated. The information given herein is taken from sources that IFP Advisors, LLC, doing business as IFP, IFP Securities, LLC, doing business as IFP, and its advisors believe to be reliable, but it is not guaranteed by us as to accuracy or completeness. This is for informational purposes only, and in no event should be construed as an offer to sell or solicitation of an offer to buy any securities or products. Please consult your tax and/or legal advisor before implementing any tax and/or legal related strategies mentioned in this publication, as IFP does not provide tax and/or legal advice. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors.